We just had a terrible month in the stock market. Over the past few weeks, the S&P 500 is down more than 10%. Day after day, stocks were in the red. Year to date, the index is now down over 21%. Fear is very high as people are hesitant to buy stocks. So what have I been doing? Well, I've been taking advantage of these market conditions and making major adjustments to my portfolio. I sold over $21,000 in stocks and redeployed that along with new cash to buy $23,000 worth of stocks. Over half of that investment was in just one position. In today's video, I'm going to explain why I sold, what I bought, and the overarching logic that influenced that decision. This will include some wisdom from legendary investors like Warren Buffett and Charlie Munger. Additionally, I'm going to share a great piece of advice from Warren Buffett on the relationship a long-term investor should have with stock market prices. I think this will help refresh people's mind on some of the fundamental investing concepts to remember in these turbulent times. At the end of the video, I'm going to explain what are the factors causing this current stock market crash and how I'm thinking about investing into the coming year. Let's roll the intro. My name is Zach and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout this portfolio update, I will be using my own dividend tracking software available at dividenddata.com. On this platform, you can analyze multiple portfolios, track your dividend income, and conduct in-depth stock research. I keep adding new features and the service will continue improving with time. You can sign up using the link in the description and pinned comment. Now let's dive into my portfolio. This is my long-term dividend growth portfolio. The goal of this account is to build a compounding source of passive income focused on the total return on dollars invested. I'm currently reinvesting all of my dividend payments, building it up so that I could one day have the option to live off dividends if I choose. It should also be noted that I have a long time horizon as I am in my early 20s. The current total value is $99,505 with $89,134 initial dollars invested to fund my account. The total return, including reinvested dividends, is 11.64%. Since starting my account, I've earned $6,809.84 in dividends. Year to date, I've received $2,593.78. This is all money that I'm reinvesting to buy more stocks, increasing my future earning power and dividends. In September, I had my largest month of dividend income so far at $428.64. This puts my real 3-month rolling average at $273.52. If you've been a frequent viewer of my channel, you may have already started to notice some big changes. First off, my projected annual dividend income is actually lower than it was in the month prior, now sitting at $2,943.97. My yield on cost is lower at 3.09%, my compounded yield on cost is lower at 3.3%, and my overall snowball effect from reinvesting dividends is lower at 0.21%. So what changed? Well, I completely sold out of multiple positions and redeployed that with an overall lower starting dividend yield and higher dividend growth. I'm going to break all that down right now and then explain the logic behind this major decision. In total, I sold 7 holdings valued at $21,306.75. This included many companies we've covered frequently on the channel. The J.M. Smucker Company, Walgreens Boots Alliance, AT&T, Warner Bros. Discovery, 3M, Johnson & Johnson, and Scott's Miracle-Gro. You can see the price at which I sold each stock here. Also, it should be noted that I sold most of these at a loss. By selling these stocks, I by no means think that these companies are terrible investments or are going out of business. I actually think that many of these stocks are undervalued and could be a good deal in the market. My reasoning for this change was largely based around the concept of opportunity cost. I saw opportunities in the market to buy companies which I viewed as far higher quality and a better value to hold long term. Since I have a limited amount of capital, I sold the companies I liked less to buy the ones I liked far more. We'll talk more about this thinking later with some analysis from Warren Buffett and Charlie Munger. So what did I view as this opportunity worth buying? I purchased 50 shares of Microsoft at a cost per share of $237.50 with a total cost of $11,874.87. This is over half of the money I invested in the month. I view Microsoft as one of the best businesses in the world with fantastic fundamentals and a clear trajectory for growth over the next decade. I'll talk more about this later. Additionally, I bought 25 shares of Texas Instruments at a cost per share of $158.57 with a total cost of $3,964.32. Here I was able to open a position at an attractive price in a dividend growth stock I've been targeting for quite a while. Texas Instruments has a clear path for reliable growth and a strong moat in the semiconductor market. I bought 109 shares of Intel at a cost per share of $27.02 with a total cost of $2,945.45. This is a stock that, in my opinion, has gotten way too cheap. Investors are very negative on the company, but I do think over a long time horizon, they will be proven very wrong. In the meantime, I will gladly buy Intel at a 5.4% dividend yield on cost. Next, I purchased 59 shares of the Altria Group, ticker symbol MO, at a cost per share of $41.38 with a total cost of $2,441.44. I got this at a whopping 9.09% dividend yield on cost. In my opinion, this is the best high-yielding stock you can buy. They have reliable cash flows with a strong moat. On top of this, they have reliable dividend growth. They just increased their quarterly dividend another 4.4%. I bought 11 shares of T. Rowe Price at a cost per share of $107.65, bringing it to a total cost of $1,184.20. My yield on cost is 4.46%. Finally, I bought 4 shares of Visa at a cost per share of $186.92 with a total cost of $747.68. In my opinion, all 6 of the companies I bought are more attractive to hold over a long time horizon than the companies I sold. I think that they have stronger business fundamentals and trade at more attractive valuations relative to their growth rates. Comment below if you want a full updated stock review video on any of these companies. As I mentioned earlier, the concept of opportunity cost was the main driving factor in my decision to adjust my portfolio. In the following clips, Warren Buffett and Charlie Munger explain when to sell a stock and how to think about opportunity cost when investing.
Originally, when I was working with tiny sums, I always had way more ideas than I had money. So I had a portfolio, very limited dollar amount, and I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood. Over the years, as more and more capital is accumulated for which I'm responsible, frequently money outruns ideas. I have more money than ideas. So now the only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced.
You look at a corporate stock, it's obvious you can buy any maturity of government bond you want. So one opportunity cost of buying the stock is to compare it with the bond. Well, you may find that half the stocks in America you're so fearful about, or know so little about, or think so poorly of, that you'd rather have the government bond. So on an opportunity cost basis, they're taken out of the filter. Now you start finding corporations where you like the stocks way better than government bonds. You've got to compare them one against the other. And when you find one that you regard as the best opportunity, that you can understand as the best opportunity, now you've got one to buy. It's a very simple idea. Life is a whole series of opportunity costs. You got to marry the best person who is convenient to find who'll have you. Investment is much the same sort of a process.
This idea of opportunity cost was what was driving my decision to rebalance my portfolio. I found stocks I really thought were a great deal to hold long term. Specifically, Microsoft was the major influence in this decision. I don't have unlimited money to invest, so I had to ask myself what I thought was the most attractive opportunity. As stocks fell to new lows, I began to compare. Would I rather own Microsoft at the current price or XYZ stock in my portfolio? When that decision was very obvious in my mind, I decided to sell the stock and buy Microsoft. So what is it about Microsoft that I like? Well, it's difficult to find a higher quality business. They just announced a dividend increase of 10%, and I'm confident that it will have high and, most importantly, sustainable dividend growth well into the future. Over the past 10 years, the compound annual growth rate of the dividend is just under 12%. The payout ratio is under 30%. In recent years, their free cash flow growth has accelerated at a 16.49% 5-year compound annual growth rate. A large part of this is due to Microsoft Azure, which is their cloud computing service similar to Amazon Web Services. Microsoft and Amazon have become dominant players in this massively growing industry. Year over year, Azure is growing revenue at 40%. That's insane. It's obvious to me that this will fuel a decade of massive growth at Microsoft. I pay Azure hundreds of dollars every month for hosting and database services related to dividenddata.com. I'm a peanut in this space. There are large enterprises with annual contracts in the billions of dollars. There are so many tailwinds to fuel this growth into the future. The reliable recurring revenue and growth of Microsoft make it very attractive at a fair price. On top of this, it fulfills one of Charlie Munger's favorite qualities in a business.
We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in. There are other businesses like the construction equipment business of my old friend John Anderson. And he used to say about his business, you work hard all year, and at the end of the year, there's your profit sitting in the yard. There was never any cash, just more used construction equipment. We tend to hate businesses like that.
Yeah, it's a lot easier to understand a business that's mailing you a check every month.
Microsoft is one of these companies where the cash just keeps piling up. It has one of the best balance sheets you can find. They have $104 billion in cash on hand, and their net debt sits at an impressive negative $43.4 billion. Microsoft is drowning in cash, and it just keeps piling up from all their recurring revenue. They have clear areas to reinvest to fuel future growth. On top of that, this means they will continue to reward shareholders with more share repurchases and dividend growth. Thank God the market has seen a downturn in 2022. I was able to substantially increase my position in a great company like Microsoft at what I think was a very fair price. I will continue this process of actively evaluating my portfolio. In the coming weeks, I could sell out of a few more holdings with the same opportunity cost logic. Market declines and volatility can be a massive opportunity for the long-term investor. However, many turn these swings into a negative by letting the market dictate their opinions on investments. In the following clip, Warren Buffett uses the allegory of a farmer and his neighbor to perfectly explain this concept. This is similar to the Mr. Market idea that Ben Graham describes in his famous book, The Intelligent Investor. After the clip, I'm going to explain the real risks that are still present in the 2022 stock market and share how I'm thinking about the market at this time.
Imagine for a moment that you decided to invest money now, and you bought a farm. And the farmland around here, let's say you bought 160 acres, and you bought it at X per share, or per acre. And the farmer next to you had 160 identical acres, same contour, same quality of soil quality. So it was identical. And that farmer next door to you was a very peculiar character, because every day that farmer with the identical farm said, I'll sell you my farm, or I'll buy your farm at a certain price, which he would name. Now, that's a very obliging neighbor. I mean, that's got to be a plus to have a fellow like that with the next farm. You don't get that with farms. You get it with stocks. But just imagine if you had a farmer doing that. When you bought the farm, you looked at what the farm would produce. That was what went through your mind. You were saying to yourself, I'm paying X dollars per acre. I think I'll get so many bushels of corn or soybeans on average. Some years good, some years bad. Some years the price will be good, some years the price will be bad, etc. But you think about the potential of the farm. And now you get this idiot that buys a farm next to you, and on top of that, he's sort of a manic depressive and drinks, maybe smokes a little pot. So his numbers just go all over the place. Now, the only thing you have to do is to remember that this guy next door is there to serve you and not to instruct you. You bought the farm because you thought the farm was had the potential. You don't really need a quote on it. If you bought in with John D. Rockefeller or Andrew Carnegie, and there were never any quotes. Well, there were quotes later on, but basically, you bought into the business, and that's what you're doing when you buy stocks. But you get this added advantage that you do have this neighbor who you're not obliged to listen to at all, who is going to give you a price every day, and he's going to have his ups and downs, and maybe he'll name a selling price that he'll buy at, in which case you sell if you want to, or maybe he'll name a very low price and you'll buy his farm from him. But you don't have to, and you don't want to put yourself in a position to where you have to. So stocks have this enormous inherent advantage of people yelling out prices all the time to you. And many people turn that into a disadvantage. If you really had a farm and you had this neighbor, and one day he offered you $2,000 an acre, and the next day he offers you $1,200 an acre, and maybe the day after that he offers you $800 an acre, are you really going to feel that at $2,000 an acre, when you had evaluated what the farm would produce, are you going to let this guy drive you into thinking I better sell because his number keeps coming in lower all the time? It's a very, very, very important. Bring the right psychological approach to owning common stocks.
The fundamental lesson here is that the market exists to serve you, not to instruct you. This can be difficult to follow in volatile times, but it's important to keep in mind as a long-term investor. In my view, I was following this approach when buying my Microsoft stock. My cost was higher, and as the price continued to fall, I viewed it as an opportunity to buy more as it fell. I also think that this applies to my continued buying of Intel stock after its recent sharp decline. It's difficult, but you should try to determine your opinion on a stock's value independent of the current market prices. In all of these areas, I have plenty of room to continue improving. As I mentioned earlier, the stock market has seen a major decline in 2022. Specifically, the past month has been terrible. However, the past 2 days have been in the green across the board, leading some to have hope we may have bottomed out. To that, I will say that I have absolutely no idea. What I do know is that there are still major risks that the stock market is concerned about right now. Number one is rising interest rates as the Federal Reserve attempts to fight inflation. I wrote this entire blog post about why this matters and shared a prior video that I made that explains this in detail. Check out both of those and they will be linked in the description. Factor number two is an earnings recession in 2023. The interesting thing about this is that it's likely going to be caused by the Fed raising interest rates. In short, higher interest rates and lowered earnings mean stocks are going to be valued less. However, I like to approach this on an individual company by company basis. It's my view that companies like Microsoft will continue growing in 2023 and beyond. So I have no idea if we're at the bottom, but I am more than willing to deploy capital in an individual company that I think is a good deal. All of this is just my opinion, so be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to track your portfolio just like me and join a Discord community of like-minded investors. Follow me on Twitter for real-time dividend news, and thank you for watching.